Good morning, everyone. This is Scott Jones, Director of Business Development for iSectors. I'd like to thank you for joining us today to review iSectors' third quarter 2014 performance updates. Joining me today will be Chuck Self, Chief Investment Officer of iSectors. Chuck will be providing a brief third quarter performance overview of all the iSector models and conclude with his near-term economic perspective on the markets. This call should last about 15 minutes with Q&A to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box in the upper right-hand corner of your screen. This presentation will be recorded, and a copy will be available on our website this afternoon at www.isectors.com. Just click on the iSectors blog icon, and it'll take you to a link to access the recording. We will also be sending a link to access the recording of this presentation to all webinar attendees immediately after this call. So with no further ado, I will now turn the call over to Chuck Self, Chief Investment Officer of iSectors.
Thank you, Scott. Good morning. The iSector allocations were generally affected by the strong dollar in the third quarter. The dollar had its sixth strongest quarter since 1980 with a 7% rise. This translated into significantly negative effects on global assets priced in dollars, such as commodities. Once these commodities started to decline, there was technical selling that took place, leading to further declines. Thus, as you see in the chart on slide 3 of the Central Fund of Canada, a closed-end fund holding physical gold, September became a very difficult month for precious metals market. This downdraft in commodities had the strongest effects on our inflation protection and precious metals allocations. The inflation protection decline was not as large as the precious metals decline due to the more diverse holdings in its portfolios, such as Treasury Inflation Protection Securities, or TIPS, and Master Limited Partnerships, MLPs. The dollar strength affected many of our other allocations to some extent. The post-MPT allocations benefited from a positive market in the quarter, but were hurt by overweight to energy and gold mining positions. Healthcare and finance exposures also helped performance. The model has reduced energy positions and eliminated gold mining securities from the portfolios. Growth is overweighted in healthcare and technology, and moderate is overweighted in healthcare and bonds. Even with the disappointing quarter, post-MPT growth is ranked 16th among 670 ETF strategies for one-year performance in the Morningstar ETF Strategies database. Also, the chart on slide 4 plots risk as measured by the historical maximum drawdown on the horizontal axis and annualized return on the vertical axis. As the chart indicates, on a risk-return basis, post-MPT growth continues to outperform all major asset classes during its 9.5-year history. Since the liquid alternative allocations and its portion of the endowment allocation have exposure to real assets, including commodities, these allocations underperformed in a quarter also. The chart on slide 5 shows the decline in one of the commodity holdings during the quarter. Again, you can see the accelerated drop in September when the dollar gained strength. In addition, both stocks and bonds, which are used in the benchmark for the endowment allocation, continue to outperform liquid alternatives. Both allocations are broadly diversified and should recover as the markets stabilize. The dollar strength could be attributed to the relatively robust U.S. economy compared to our European and Asian counterparts. Thus, U.S. stocks outperformed international equities due to their stronger earnings growth. In addition, the equity portion of our global allocations are tilted toward dividend-paying securities that underperformed growth stocks in the quarter. International bonds were hurt by the stronger dollar's effects on interest payments. Again, even with the underperformance in the third quarter, the iSector domestic and global allocations have earned very attractive returns over the past 3 years compared to most ETF strategies and the international benchmarks, such as the MSCI All Country World ex-US Index. In fact, the domestic equity allocation is 10th in the Morningstar ETF Strategies database in 3-year performance. As the chart shows on slide 7, capital preservation has earned 3% on an annualized basis over the past 3 years. The current yield is attractive with short duration while maintaining investment-grade quality on average. Stock market volatility in the quarter led to underperformance by the global high-yield bonds, which are owned in the portfolio. These bonds detracted from performance in the allocation. Finally, the tactical allocations were also hurt by the strong dollar and weaker earnings expectations abroad. You can see the difference in performance between the U.S. large cap index, which is in black on the chart on slide 8, and the international large cap ETF in green on the chart on slide 8. The tactical global balanced is 50% invested in a variety of asset classes, with the rest in cash equivalent. Tactical international allocations has a 90% cash holding, waiting for the markets to turn. As far as our economic outlook and market outlook is concerned, as veterans in the market, we all know how difficult the September-October period can be. Studies show that these 2 months have the highest stock market volatility of any 2-month period historically. Our quantitative models continue to be very bullish, which is being supported by generally strong third quarter earnings reports. And so far, about 80% of the earnings reports for the third quarter have been above expectation. Also, interest rates are likely to stay low longer than currently anticipated, given the declining inflation rates that we are experiencing in the U.S. Our belief is that the stock market is stabilizing and that it will eventually go to new highs.
Thank you, Chuck. We will now begin the question and answer portion of the webinar. If you have any questions for Chuck, please type them into the chat box in the upper right-hand corner of your screen. We do have a few questions. The first question, will post-MPT be able to handle another correction?
Yes, we believe that it will. Again, this wasn't even a technical correction that we experienced. It never, S&P 500 never went down 10%. It got close, but never went down 10%. And it has recovered much of it. In fact, through Friday, we were less than 1% below where the market started in October. So the market seems to be stabilizing. And we think that once we get to buy the earnings reports of those companies that have been affected by the dollars, and there seems to be some leveling in economic strength both in Europe and in Asia, the market will have the ability to recover. And the other thing is that November, December are usually a great months to be invested. So this has been a good time to pick up new stocks, new ETF holdings in the market at relatively low prices.
Thank you, Chuck. We also have another question. Do you think the dollar will continue to strengthen?
Well, historically, on a technical basis, when currencies move, they tend to move that way for a long time. And so it's likely that the dollar will continue to do well. Also, it's clear that our major trade partners in Europe and in Japan and China are experiencing slower growth, while the U.S., if anything, has been experiencing accelerating growth. So that has been positive for the dollar. So as we indicated in our post-MPT allocations, we have reduced our exposure to dollar-related assets quite significantly, and we're waiting to see when these allocations may come back in. But in the meantime, for those long-term investors, this could be a time to pick up or to have assets allocated to our precious metals and inflation protection allocations, because the prices are relatively low, and eventually we expect inflation to reemerge.
Thank you, Chuck. Another question is, how does global versus domestic look this quarter?
Well, this quarter, if you're talking about the fourth quarter, it is already both of them obviously were affected by the market declines. The domestic has come back up with the market, and the U.S. market has done relatively well this quarter. So it's likely that the domestic allocations are doing better. But again, it's hard to predict when the dollar increase will stop, and long-term investors should continue to hold their holdings, whether it's global or the domestic equity holdings.
Thank you, Chuck. Well, there are no other questions at this time, so Chuck and I would like to conclude by thanking everyone for attending our webinar this morning. If there is anything we can do to assist you with your wealth management or 401k asset allocation needs, please let us know. I can be reached directly at 800-869-5184. Again, thank you, and hope you have a successful week.